Okay. Carin and Mike, are you ready?
We're ready.
Ready?
Okay. Well, welcome. Welcome to the hundreds of people that have joined us this afternoon. I have to admit that I find it very awkward to talk to all of you while staring at myself on a computer screen, but I hope everybody out there is healthy, doing well, and that gain some value from what we're about to say over the next hour. I want to do just a couple of housekeeping items before I outline what we're going to do over the next hour. Firstly, a number of you have asked questions and sent them in ahead of time, and we've tried to incorporate those into our remarks. You also have the ability to ask questions with the Q&A function. That's the function that should be enabled. The chat function, I don't know if it's enabled, but it shouldn't be, because we're going to be monitoring the Q&A. We will be looking at those during the course of our remarks, but in the last 15 or 20 minutes, we'll try to address many of the questions that come in through that app. We may not be able to get to all of them, or maybe we won't be able to get the specific nuance. We're still available. Feel free to call us and we can discuss these offline. We also can discuss this in our regular meetings over the course of time, as we always do. Before we get into the substance of what we're going to discuss today, I just want to say a few things. This is a very difficult time for all of us. Obviously, there's a great deal of anxiety, and it's probably an appropriate time for me to mention, on behalf of myself, Carin, Mike, the entire GHPIA crew, that we know that all of you are an amazing group of very successful people. And what may not be readily apparent all the time when we are talking to you in our meetings is how much we gain from all of your wisdom. All of the hundreds of people out there today who come from such a wide variety of occupations, a wide variety of, sorry to interrupt real quick. I just have to talk to our host who's in a remote location. Gary, are you, I hear background noise. I think it's coming from your location.
Okay, sorry, I'll quiet that down.
Okay, sorry about that. We have clients that work in healthcare. They run hospitals. We have clients that are physicians. We have clients that are nurses. We have clients directly dealing with this epidemic. We have many clients who have shared their wisdom with us about the epidemiology of what's going on with this COVID-19. I want you to know that I could not even pronounce the word epidemiologist a month ago, and now I believe all of us are armchair epidemiologists. Nonetheless, we also have business people. We have people that own businesses that are in retail locations that had to shut down due to the closures. We have owners of those very same malls that are wondering whether they can collect rent, whether they can pay the bank. We have bankers. We have that are concerned about whether their loans will be repaid. We have a wide variety of professionals, lawyers, CPAs, dentists that are shut down as a result of this. We have people in the oil and gas business. We have people in the political realm. We have people across the board that have shared their wisdom with us and have really helped us to understand all the nuances that are going on with this situation. Sorry, I'm starting to get a little more emotional than I thought I would. So, with that said, we want to add to the collective wisdom that you already possess with our perspective. And our perspective is really going to come in the three parts that Carin, Mike, and I are going to present to you. First, I'm going to walk through some of the big picture macroeconomic implications of what we are experiencing now, what we're likely to experience in the coming weeks and months, talk a little bit about the government's response, at least so far, And then I'm going to hand it over to Mike, who's going to talk a little bit more about how this crisis relates to other crises that we've lived through together as well as a country, and a little bit of the financial implications. And then Carin is going to go through many of the implications for the portfolios that we manage, some of the decisions that we've made in recent weeks, and some of the advice that we generally give. So if you'll permit me, just for the next 5, 6, 7 minutes, first I'm going to spend 2 or 3 minutes raising your anxiety level. Don't worry, I'm going to then hopefully bring that anxiety level down. Why am I going to raise your anxiety level? Because the news that we have already experienced that has already impacted the financial markets is actually only the beginning of this economic crisis. With that said, Carin will get into it in a much more deep way, why it is that the financial markets always react first and they always react fast. The economy follows. So let's get into a little bit of what I'm talking about. For any of you that have taken Economics 101, on page 1 of almost every textbook is a diagram called the circular flow. In fact, that diagram is usually, you look at it, you go, oh, that's nice, that's how the economy works. And then the professor doesn't even bother to include it on the test because we take it for granted. What is the circular flow? Well, when consumers buy goods and services from businesses, and those businesses turn around and pay their employees the same money that the consumers just paid them, they pay to their employees, which of course turn right around and use those dollars as consumers with businesses. That's the circular flow. We take that circular flow for granted because it always circulates. And I want to use that imagery to describe the economic circumstances that we're living through now compared to what normally happens when we go through something called a recession, or God forbid, a depression. Normally, in a recession, the circular flow continues to circulate. Normally, what happens is during good economic times, those businesses require credit so that they can produce those goods and services, and the consumers require a certain amount of credit so they can buy those goods and services. When everything's healthy, there's a healthy amount of credit for consumers, and there's a healthy amount of credit for businesses. But as we all know, there's a cycle. And what usually starts out healthy eventually gets to be a little bit too much. So that when there's too much credit going to consumers, they start to live above their means. And when there's too much credit going to businesses, they start to build and buy assets well above what they might require. And a typical recession is the period of reckoning between those excesses, when there's a little too much credit in the system for consumers and a little too much credit in the system for businesses. When we get that correction, it's called a recession. When there's a lot of credit and there's way too much credit in the system and the day of reckoning comes, we get a big day of reckoning, and that's called a depression. In a recession, in a depression, the circular flow continues to circulate. That is not what we are experiencing today. Today, we did not have an excess of credit for consumers or for businesses. Mike is going to talk much more about that. We did not have the typical recession where that contraction of credit leads to a reduction in the volume of that circular flow. And we did not have a situation that because there was too much credit, financial institutions might fail on a large scale. That is not what occurred. In fact, that cycle, in very condensed form, I know, that I just outlined, has been essentially the trigger of almost every recession, including the Great Depression, since the Industrial Revolution began in the 18th century. What has never happened, certainly not on a national scale, nor has it happened on a global scale, is the stoppage of that circular flow. That's what's happening now. As a result, when we start to look at what is going on in the economy, you are about to read extremely disturbing headlines, which I'm going to quantify in just about a minute. But as disturbing as those headlines are going to be in a quantitative sense, they are very different from what occurs in a typical recession or in a depression like we had during the Great Depression. It's more like a blizzard in Colorado or a hurricane in Florida when all business stops because of an act of God. By the way, for those of our clients currently tuning in from Southern California, call us later and we'll explain to you what a blizzard and a hurricane look like. Meanwhile, this, of course, is on a much larger scale. The flow has stopped to circulate. Now, why is that going to create tremendously difficult headlines? And why is it that I suggest that we not freak out about those headlines? Let me enumerate. Last year, the United States produced $22 trillion of gross domestic product, GDP. That's the total value of all the goods and services bought and sold in billions and billions of transactions in the United States economy. Very rarely do we look at that number in the way that I'm about to have you look at that number. If you take that $22 trillion and you divide it by 365 days in a year, actually this year 366, who's counting, that's $60 billion per day. We at GHP Investment Advisors have done our own calculations going through industry by industry on the GDP report, and we've correlated those calculations with other banks like Goldman Sachs and JP Morgan. And it looks to us as if the GDP of the United States on a daily basis has fallen from about $60 billion per day normally to about $48 billion at present. That's a 20% decline. For those states like New York, California, and currently the city of Denver that are under even more severe restrictions, GDP is probably already running 30% below what it was just 3 weeks ago. A 30% reduction in GDP is equal to the total reduction that we experienced from 1929 to 1933 during the Great Depression. That was the total decline over that 4-year period of time, the cumulative decline. Right now, we have not experienced a 30% cumulative decline. We're just now running at about a 20 to 30% daily decline. By looking at it that way, we can quantify how many days until we get a reduction in economic activity equivalent to other recessions and the Great Depression. So for example, during the 2008 and 9 recession, the economy shrank, GDP fell by 4.3% cumulatively, 4.3%. Based on the current rate of daily decline in GDP, we will experience a similar cumulative decline over the next 77 days. If we were to live under the restrictions that we are currently living under, and in fact, if they tighten even a little bit more, we can expect that the total decline in economic activity will only approach what we experienced in 2008 and 9 over the next 77 days. Similarly, it will take 1.5 years for us to experience an equivalent cumulative decline in the economy equal to what that cumulative decline was from 1929 to 1933. So all of the talk that you're about to hear of depression economics is extraordinarily premature. Then let me just finish up by saying, even if we experience a decline similar to what we experienced in 2008 and 9, it is not going to be the same experience. Mike and Carin will outline for you why that experience will be different. They're going to talk about what was different coming into this period. But part of the reason that it's going to be different is that the government, particularly the Federal Reserve, and we hope Congress, obviously it looks like they're starting to get their act together, are pulling out very large guns. I would say that they were pulling out the bazooka, but that is much too small. I don't know what weapons are bigger than bazookas. I don't know what weapons are bigger than ICBMs, but these are bigger than all of those. And unlike the 2008-9 situation, this situation, which some are now calling the Great Secession, as opposed to a recession, the government is behind the curve relative to the healthcare risks, but the Fed and the government are well ahead of the curve when it comes to the financial risks. And I won't get into too much detail, but maybe we can during the Q&A. But suffice it to say that the Federal Reserve has already come out to stabilize a wide variety of markets that have become very unstable, and Carin will talk about what those are and how we reacted to those. And what Congress is now debating is, in our opinion, finally moving in the right direction. Originally, they were talking about stimulus. They fell back on old economic habits where they wanted to stimulate the economy by putting cash into people's hands, and that would have failed, because even if you provided so-called stimulus, the problem here is we have outlawed spending for a wide variety of activities. What we need and what it looks like we're going to get is support. Support for the unemployed in a way that they've never been supported before, so that they can pay their rent, they can pay their mortgage, they can pay their utilities, and they can buy food. We also need to support idled businesses, and many of the programs that are in these packages aim to do just that. And the last thing I'm going to say on this, then we'll talk about unemployment, and I'll turn it over to Mike, is right now, this package is $2 trillion, if it passes as it is now, in federal government spending. But the Fed is going to take a portion of this and is going to add about $4 trillion to this, so that this total package will ultimately be $6 trillion, $4.5 trillion of which will be short-term loans to keep businesses afloat and employees on payrolls if they act quickly and get this done in a reasonable way. Finally, why do they need to do it? In the Great Depression, unemployment went to 25%, and that was a historic record. Let me put this into perspective. There are, in the United States, 16 million people that work in restaurants, 30 million that work in face-to-face occupations that include restaurants, hospitality, tourism, retail. There are 60 million people who are associated in those industries that don't necessarily work face-to-face with the customer. And there are 80 million hourly employees in the United States. It is already baked into the cake, both economically, and I would argue in the financial markets as well, that the unemployment rate is going to hit, when measured by the unemployment data, levels that we have never witnessed before in American history. Do not panic when you see those numbers, because it is in fact temporary. The financial markets already understand that's what's going to happen. And the reason that they've reacted positively over the last couple of days is because they understand that the government and the Fed does indeed have the firepower to stem the losses as long as we keep this quarantine situation that we're in reasonably short, measured in months rather than years. I'll end here and turn it over to Mike Sullivan, but in the Q&A, we can address any more specifics that you might have.
Thanks, Brian. And let me make sure, Carin, Brian, can you guys just tell me if you hear me good on your side?
Good to go.
Great. All right. I wanted to second what Brian was saying about how uplifting it has been in this period of relative isolation to get your emails and your phone calls and the stories I've heard that you've regaled me with. It's been wonderful to hear from you all. We miss seeing you in person, but at least we're able to be in front of you today this way. And so to those who listened to Brian's radio interview recently, I thought I could kind of expand on his comments. And as he just mentioned, that this is an economic crisis, but we do not view it in the same context of a crash. And to give some color to that, I thought I'd bring up some historical perspective, starting with 1907. So back 120 years ago, there was a bank panic in the United States known as the Knickerbocker Panic because it started in New York. Why it's relevant is that, just as Brian had mentioned, it was one of your classic panics where a crash of the stock market of nearly 50% occurred in a few short months, and the economic crash ensued because of excessive debt and leverage in the financial system. And the aftermath of this, actually, the crash itself was spreading throughout the entire country, and hundreds of banks were going belly up until JP Morgan, not the bank as we know it, but the James Pierpont Morgan stepped in with his own financial backing to shore up the banking system. And so in the aftermath of that crash, it was essentially the impetus that then fostered the creation of the Federal Reserve as we know it now. The Federal Reserve at first, in those days, was implemented to be the lender of last resort. And so another crash subsequent, of course, and Brian just referenced this too, the Great Depression, the crash of the 1929 stock market, likewise, a period of excessive debt and risk-taking. Just to put it in perspective, nowadays, as individual investors, we have margin in our portfolios that are allowed but regulated only up to 50%. So that means if I have $1 million portfolio, I could take 500,000 out of the portfolio on credit. In those days, in the 1920s, the Wild West of the stock market, margin requirements were not regulated. And so it was not rare to have investors, individual investors like you and me, that had over 80% margin. In addition, those highly margined or highly leveraged investors were buying into what were known as kind of the newfangled investment schemes of the era, investment trusts. Those investment trusts were managed by individuals who were likewise investing in companies that had radically high levels of debt and leverage. So you had this in the stock market system, highly leveraged investors buying into investment trusts that were highly leveraged, And in the run-up of the late 1920s and the stock market rally, it was essentially like a skyscraper that was built out of matchsticks. And as soon as the economic wobbles began, all of that came crashing down. And of course, then the crash was so severe, 80% losses in 1929 in the Dow Jones through the 1930s. So quite severe stock market losses, but this bled into the banking system. And likewise, households were highly indebted. In those days, we had radio as the new technology and automobiles. And 8 out of 10 radios and cars that were purchased in those days were done so with debt. So consumers in the household sector were likewise heavily indebted, just like investors and the banks. And of course, you have an absolute crash, more devastating than anything we've ever experienced. The unemployment rate that Brian just referenced, it stayed in the double digits, above 10% unemployment until 1941, just to kind of give reference to how long and how severe that crash was. And then thirdly, and I should mention, during that crash, the Fed, in its infancy, relative infancy, started in 1913. Obviously, here in the 1930s, the Fed is still relatively new. Instead of operating with the monetary policy that we know today, where you have economic distress and the Fed steps in quickly to lower interest rates, the Fed raised interest rates during the Great Depression to stick with the gold standard that we were on in those days. And clearly, by raising interest rates instead of lowering interest rates in that era, that exacerbated the problem and extended the economic crash for many years. Now, the most recent crash that we have to bring to bear would be, of course, the 2008 housing bubble. And likewise, thirdly, a period of over-leveraged households, over-leveraged banks and financial institutions. When we look at all of these examples, the household, or I should say the crash of 2008 was over 50% losses for the US stock market. And we all know how long it took for all of those unemployed to get reemployed. All three of these examples are periods where the Fed basically had to learn from lessons of those crashes. And we believe not only have households, corporations, and banks learn from these lessons in the past, but clearly monetary policy, as Brian just mentioned, in the past few weeks has acted quite swiftly and at unprecedented levels, learning from the lessons of those crashes in the past so that this current economic crisis does not then become a series of bank failures and therefore a full-on stock market crash, full-on economic crash. And about 3 examples of just where we see that as we came into this economic crisis and this pestilence, where we were on better footing in terms of sound management of debt in the household sector. We've talked about this a lot in meetings with clients over the past few years. We've looked at things like our mortgage payment as a percentage of our household income. That ratio has hit its lowest level in over 30 years. So households being able to cover their mortgage as a percentage of their income much more healthy, much healthier ratio than we saw certainly 13 years ago. Likewise, FICO scores for households. Loans at origination, mortgages at origination last year, the average credit score, FICO score, was 755, an incredibly strong FICO score for those taking out a mortgage. Whereas 13 years ago, FICO scores on average were 700 or less. So much better borrower, much better ability for households to cover their mortgage payments coming into this crisis. Likewise, the banks. We've talked about Tier 1 capital ratios with clients quite a bit over the last couple of years. And whether it was the Dodd-Frank regulation or just the bank ownership intelligently responding to better lending standards and cleaner management of balance sheets, Tier 1 capital ratios, this is the safe capital on a bank balance sheet. It's the capital that protects the bank from unexpected losses, the kind of losses that, as Brian summarized, could be coming in the months ahead. But that cushion on the bank balance sheets by way of Tier 1 capital ratios has in most banks in America more than doubled in the last 10 years with this sound management of bank balance sheets. Then, and the third sector, the corporate sector, and we've talked about this a lot too, corporations more broadly coming into this crisis by a number of standards. One that we assess would be debt to asset ratios. So considering the total debt of a corporation divided by its total assets, we have seen for companies in the S&P 500, or broadly speaking, in the S&P 500, the lowest debt to asset ratios in over 20 years. And another measure that we like, interest coverage ratios for corporations. Here, this is the earnings that a company has over its interest expense on its debt on an annual basis. Those interest coverage ratios have more than doubled since the financial crisis. So whether it be the ability for corporations to manage their interest expense over these coming few quarters as obviously earnings get thin, they are much more soundly built to get through this crisis, or their debt to asset ratios as a whole, much better. Likewise, households and banks are living with much sturdier balance sheets coming into this crisis. The debt management issues that precipitated the crashes of those three periods I've summarized, we are handling debt much better coming into this crisis, wherein we feel this is a crisis, one of certainly quite a pestilence, but not the kind of crisis that can become a broader series of bank failures and therefore a crash. And we want to make that distinction. Also, when we're investing in your portfolios, we take the same analysis of financial risk and we apply it always when we're selecting companies for your investments. Financial risk is one of the four risks that we consider. In the same sense I've already summarized, when we look at a company, it may have wonderful profits, but if those profits are only earned because a company is taking on recklessly high levels of debt, we're going to avoid it. We always have. So by looking at companies that have a steady profit but without excessive debt, that debt to asset ratio, that's something that's attractive to us. And we came into this with companies in your portfolio that had attractive, reasonably managed debt to asset ratios among other financial risk factors that we consider. Secondly, as you know, always valuation risk, price to earnings ratios, price to cash flows. We have always avoided companies with radically high prices relative to their earnings. We know that when you go into a period of economic distress like we're heading into now, if you were trading in the market at radically high prices and now your earnings get a little distressed, that has a much more precipitous fallout for your stock price versus companies that were just trading in normal valuation levels, reasonable price to earnings, whereas the company stock price can absorb a period of reduction of earnings and come out the other side relatively unscathed. Thirdly, operating risk. And this ties into the fourth, which is economic risk more broadly. But operating risk is something we're always focused on by considering stability of profits of the companies in your portfolio. So very critical to how we invest. Think of us as when we look at company profit margin. So if a company makes $1 billion a year of revenue and they have 100 million a year in profit, that's a 10% profit margin. We like companies that have exhibited through periods of all types of economies, relatively stable profit margins, sort of your steady eddies, in that they may have 10% one year on a good year, but on a bad year, they don't dip down to no profit. They maybe live in the neighborhood of 5 to 7% or something like that. We want stable profits, and we know when we're thinking about economic risk in investing in the companies in your portfolios, that the steadier your profit, the better ability you have to absorb the kind of economic risk that we're now confronting. So when we look at the macroeconomic picture, when we look at the crashes of the past 100 years, we want to make it very clear, and adding to what Brian said, this is an economic crisis, but it is not a crash. It is not more broadly going to be a series of bank failures. Very importantly, the Fed, by learning from those lessons of the past, has acted very swiftly to jump in and shore up the banking system. And even as recent as Monday morning, doing some rather unprecedented things, taking it even further than the 2008 playbook, which they followed very quickly this time around. But going so far on Monday morning to backstop not just financial institutions and banks, but also small businesses and medium-sized businesses with lines of credit. So whether it be monetary policy, banks, corporations, households, all of those areas, we came into this crisis on better footing and applying lessons from previous crashes to prevent this economic crisis from getting worse. And likewise, we apply that same discipline, risk management, sound investment, quantitative analysis with your portfolio, so that we believe firmly in going through this crisis that your investments will come out the other end and navigate safely through this episode. Carin, I'd like to turn it over to you now.
Okay, I just have to make a quick comment. As we were preparing, we talked about how long each of us would talk. And I said I'd go last, knowing that both of you would go over. So I'm going to try to cut what I say so we have more time for question and answers. I knew this was going to happen. So when I was trying to figure out what to talk about, it was very helpful that so many of you guys responded when you RSVP'd to this event about your biggest concern. And the overwhelming response is, hey, when do we get out? When do we stop this bleeding? And I want to say first and foremost, GHP Investment Advisors, and Brian and Mike just laid out our philosophy and our investment philosophy, but we're long-term investors. We are not short-term investors, and we certainly do not try to time the market or cut our losses at any point. Well before we entered this period of volatility, especially for clients taking money out of their portfolios, we had a significant amount of money, or depending on the situation, money allocated to less volatile investments like cash and fixed income. So I want to talk to you about why we're not market timers and why we're not going to cut and say we need out at this moment. And it really is because in order to do this successfully, you have to be right not once, but twice. So the first time you have to be right is you have to know when to get out. And the second time you have to be right is you have to know when to get back in. And the problem is that the market doesn't act rationally. It goes up and it goes down. And if you miss some of the best days, you're likely to never recover. So if you go back over the last 20 to 25 years and you look at people that missed the best 30 days in the market, they had absolutely no return over that period in time. Likewise, investors that made it through the good, the bad, the ugly. So like Mike was explaining, that made it through the financial crisis, that lived through the internet bubble that popped, that lived through 9/11, they actually had decent returns over the 20 to 25 year period. Then if you take another example and you look back to the bottom of the market, March 9th of 2009. By the way, what's crazy about March 9th of 2009, so we're talking back to the financial crisis, is that there was nothing special about that day. There was no big headline that said, hey guys, this is the end of the financial crisis, this is the bottom. There was no headline indicating that we were going to come out of this really tumultuous time. Instead, it was just a normal day during the financial crisis. And what's more interesting is if you look at statistics from like the National Bureau of Economic Research, we were in a recession on March 9th of 2009. And that recession didn't end until June of 2009. And I think what's hard to believe is that from March through June, the stock market, the S&P 500, was up 39.6%. 39.6% from a day that we didn't know was the bottom of the market. So that's why we feel very strongly in just staying in, because you can't predict the worst days or the best days, as evidenced even by Monday to Tuesday. Monday was a down day, Tuesday was an up day in the market. So I thought what I would do, and just bear with me, I'm going to read, and I probably shouldn't do this because we're running out of time, but I found this little interesting statistic. It's from BTN Research, and it's talking about the split between up and down periods in the market for the S&P 500 over the last 70 years. And so they measured it first by days. And so we're talking a 70-year period. 54% of the days were up, 46% were down. Months, 60% up, 40% down. Quarters, 66% up, 34% down. Years, 73% up, 27% down. And then finally, if you take that number over a 70-year period and you have a rolling 10-year period, during those rolling 10-year periods, the market was up 89% of the time, and it was down 11% of the time. So I know that we're getting a lot of questions coming in saying, well, this is different, this is unprecedented. So were each of those periods in time. We didn't know what the outcome was going to be, and yet staying invested proved to be the appropriate approach. As Brian mentioned, there are parts of the market that we have changed and that actually have caused some concern during this period in time. So many of you have noticed, especially those with fixed income portfolios, that we've been making some pretty big changes. So we've been selling out of the Schwab Value Advantage Fund, also out of a lot of our short-term bond funds and exchange-traded funds. And the reason why we've been doing that is that in the short term, there is a liquidity problem, and there is risk that companies may have problems paying their short-term debts. And we just didn't want to have exposure to that or create that kind of extra risk in the part of your portfolio that's supposed to be most conservative and less volatile. So what we've done is we've sold out of those parts of your portfolio, and we've started to take advantage of the FDIC insurance offered at Schwab Bank. And also we're slowly going to start investing into FDIC insured CDs. The other major change that we've been making in portfolios over this period in time is that we've been really trying to take advantage of opportunities from a tax loss perspective. So those of you that have taxable portfolios that have losses, we've been selling positions in order to create tax losses that we can use to offset gains. So basically, we've been trying to make lemonade out of lemons during this time where there's a lot of uncertainty. And then what I thought I'd do, and I'm actually keeping us right back onto time, is I thought that I would just tell you to summarize what's been the best part about conversations that Mike, Brian, and I have had over the past couple of weeks. And really, Brian said that obviously we've learned a lot from all of our clients that have different businesses, but it's also been interesting to see what everyone's doing with this time that you have to stay home and you can't really do your normal activities. So my favorite activity that a client's done is with her teenage daughter. She's downloaded an app called Calm, and she has daily meditation sessions outside in their garden. We have lots of clients that are taking really long walks. We have lots of clients that are gardening. And I was telling Brian earlier, and Brian and Mike have also agreed, they have not had one client yet tell us that they've successfully cleaned out their closet or has been able to clean out their basement and do all of the stuff that we always say we want to get around to, but we don't have time. So maybe in the coming weeks, we'll hear more productive time at home. In the interim, there's tons of questions that have come in, so we'll just start answering the questions. Brian, you're on mute. I don't know if you know that.
Thank you.
Okay.
I just unmuted. So let me take a couple of the questions. So far, the questions fall into a few different categories. Let me take a few of the questions related to some of the comments that we made regarding what the government is doing and how much debt is likely to be incurred. And I will strip out the political bias, which is coming from all sides of the aisle. So I will make it more neutral if that's okay. And then I see some other questions, perhaps Carin and Mike, talking about some of the things that you just mentioned regarding why is it that it isn't clearer when about trying to time the market and things of that nature. So let me just say that when it comes to the stimulus program that is about to be enacted, well, we believe it'll be enacted. They really have no choice in Congress. Right now, the price tag appears to be in the neighborhood of $2 trillion. And as I just mentioned, that's almost 10% of gross domestic product. And that all by itself will likely raise our debt to GDP ratio close to 85%. Now, for those of you who think that that number is higher already, of course, as with all things in the government, there's a variety of ways to measure things. When you add up the debt that we actually owe in terms of treasury bonds, the amount that we actually have to pay interest on. It will be, if we spend all this money and borrow to spend it, close to 85% of GDP. To put that on a global basis, right now, Italy, which is the second most indebted country on the planet Earth, and is a basket case not only given the current COVID-19 situation, but is an economic and financial basket case, has 130% debt to GDP. And Japan, the most highly indebted country on earth, has 200% debt to GDP. And as of yet, neither of those countries has faced a serious day of reckoning. Now, do not get me wrong. I do not advocate that we go down that path. I don't believe that. However, the United States has vastly larger borrowing capacity than either one of those countries. And at the moment, we are borrowing at very low interest rates. So the key question regarding what the cost of this period of time will be vis-a-vis the debt will depend on what interest rates are on that debt 5 years from now, 10 years from now, 20 years from now. But almost certainly, the cost of today's crisis will be paid for in the form of higher taxes and lower government benefits over the next couple of generations. We are absolutely, most definitely, borrowing from the future to solve a problem today. If we don't solve today's problem, we will not have a significant future. And if we do solve today's problems, they are solvable, they're survivable, we are resilient, and we have the financial resources to do so. However, we will have to pay for it we, our children, our grandchildren will have to pay for it over the course of time. I don't see any choice. But I believe that the financial markets, like they already have, will respond positively as we start to solve this problem. And then we'll have to make those very hard choices between the healthcare risks we're willing to accept relative to the economic damage that we're willing to incur to solve for those risks. But we should have a degree of confidence from what Mike said, that we should be able to get through this, and that the government does have the firepower, and the Fed has the firepower to help us get through it.
So I've been going through a lot of these questions, and there's some great questions coming. And hopefully for those that are anonymous, we're not able to get to any of those questions, just call us and we can talk about them. We don't know who to follow up with. So I think I will take one of the ones that seemed directed at me, which is, where should I go? Sorry, I had it in front of me and I'm not used to this. So first of all, I'll just talk, one of the questions, you invest in a lot of companies that have low or no debt, but would you agree that many will incur debt as a result of what is happening? Do we intend to modify our clients' portfolios to account for this? I thought I would take that broader. The answer is, when we're looking, and this is what Mike was highlighting, when we're looking at companies, we pay very close attention to debt relative to assets and debt relative to cash flow. If companies take on debt in order to survive this period in time where we've had an economic shutdown, it's not necessarily a horrible thing as long as there's still enough cash flow to be able to service that debt. So the answer is that will it have an impact on our investment philosophy? And the answer is only to the extent that we believe the debt is too onerous for the company, at which point we would say it is time to get out. And across the board, when you're looking at our investments, we're constantly analyzing what is the overall risk to certain industries. Will they live to fight another day? And we certainly will sell companies when we feel that the risk has exceeded either what they're selling for or the ability for them to perform well over time.
I would add to that too, Carin. Valuations have fallen significantly. And so when we quantify through our investment scorecards what is a reasonable debt to asset ratio to consider, or interest coverage ratio to consider in the years ahead. We're now starting from a point of 14 or 15 times earnings on stocks, as opposed to where we were a month and a week ago at 20 times earnings. And so that does give us a little margin of safety.
Carin and Mike, if you don't mind, I'm going to address that. We've had a few questions about Karen's comment regarding money market funds and bonds. And let me just say that many of you who we have spoken to over the last few weeks or have called us have expressed a great deal of concern about the stock market. And the stock market is, of course, in the news every day, and it's had very dramatic declines. However, the nature of this crisis is very unusual. This is a short-term crisis, not a long-term crisis. What do I mean by that? When we look backwards in time, 5 years from now, 10 years from now, we will most likely be looking in the rearview mirror at everything that's transpired here when it comes to companies, like Carin said, that come through this in relatively good shape. Because the epidemiologists, I'm going to use that word just because I've learned how to say it, so I think I need to repeat it. The epidemiologists tell us that no matter how we slice this, no matter what the response is, whether it works, whether it doesn't work, whether we need to quarantine, it's going to be measured in months. And at most, even if we let the disease rip through the population, we're talking about a period of a year to 18 months. I'm not suggesting we do that. I'm just saying that's the time frame that we're talking about. And really, the disease itself, as dangerous as it may be, is not the cause of the great cessation. The cause is all of the quarantine policies. Those are under our control as a society. So we are now calculating how much healthcare risk we're willing to accept relative to how much economic damage. If we want to stay within the confines of a highly resilient period of time, we will most likely only live under these quarantine policies for at most 2 or 3 months. Maybe we'll have to reimpose them in the winter if we get another resurgence of the disease, but it's going to be measured in months, a finite period for which the government has resources to cover. However, for the first time in many decades, maybe ever, the problem in the bond market was extraordinarily acute because there are all sorts of bonds that many of you may not be aware of because they sit in your money market funds and they sit in other traditionally very low risk short-term bond funds. Usually when we think about the short term, meaning I make a loan to you and you say, I'll pay you back tomorrow, or I'll pay you back next week, or I'll pay you back in a month. It's almost never the case that we think, oh, you know what? I'm not that worried about getting paid back 10 years from now, but I am very worried about getting paid back tomorrow. That is what has transpired in the last 2 weeks. And that is what we were reacting to at GHP Investment Advisors. And those of you who have bonds and cash, like Carin just said, in your portfolio, those were safe, but we wanted to make sure they were safer, that they were absolutely safe. So we moved out of all of the money market funds that had corporate commercial paper and moved them into either FDIC insured bank accounts or federal government backed instruments for the most part, or we moved into other forms of cash that are government securities or government backed. That was something that we took action on almost immediately when it became clear that we were moving into some sort of national and global shutdown. And I'll just leave you with one very significant example. One of the largest issuers of short-term commercial paper these loans that I'm talking about that get paid back a day later, a week later, a month later, are the automobile companies. They are in very good shape for the most part. Their balance sheets, for the most part, adhere to all of the ratios that Mike outlined. However, the government, probably rightly so, shut down their plants. And that called into question whether they could generate cash flow to take tonight's loan and pay it back tomorrow. And as a result, we believed, in any case, we had to react to that scenario. Thank goodness the Federal Reserve also reacted to that scenario. That's why we feel somewhat confident. The Federal Reserve stepped in to backstop every money market fund in America, the entire commercial paper market, in fact, the short-term bond market in its entirety. That did not stop some of the concern. And I'll give you one other small example. Mortgages. Mike is correct. The mortgage market was extremely healthy, high down payments, good credit, but guess what? All of a sudden, people out there who own mortgages began to worry, well, maybe they will be able to pay their mortgage 5 years from now, but what about over the next 5 weeks? That is a type of thinking that shocked the system, and we felt compelled to react to protect your safest assets. Carin, Mike, you want to add to Carin? You want to add to that in any way?
I mean, you just said it better, Brian.
Okay, many of you asked some very, very interesting questions. We are approaching 1 o'clock, so we don't want to go past our time too much. We hope that we addressed some of your concerns. I do apologize to Carin because she did tell me that I am long-winded and go over. So for those of you who want to hear Carin's perspective, please call her directly. But I do want to reemphasize 3 principles. 1, we do not market time. So I said, what does that mean? It's exactly what Carin said. We don't try to time when to get out. We don't try to time to get in. She gave us wonderful data why we believe that we shouldn't do that. We believe it's a fool's errand. That's the simple answer. 2, we're doing our best to address risks as they come. Many of those risks are unpredictable. And what we try to do at all times, as Mike said, to make sure that when these unpredictable events happen, you have a resilient portfolio that is survivable. As Carin said, will live to fight another day, and that you will win ultimately over the long run. And 3, we love working with all of you. We value what you bring to us. We learn so much from all of you, and we hope that this has been a valuable exchange for you as well. And we are feel it every day in terms of our own anxiety level. We very rarely worry about our own portfolios. In fact, I never hear it come up amongst a GHPIA employee, but we do take to heart very deeply what's going on with all of you. So anytime you feel anxiety and you want to discuss issues that are important to you, please call us. Very often it's difficult for us to call everybody in a crisis atmosphere one by one, but we are here for you, and we are ready to and able to talk about any issue and any concern that you may have. Thank you for joining us, and we look forward to many, many years of prosperity together.
Thank you. Thank you, everyone. Be well.
Bye, everyone.